It's with May, and we are back with another episode. This time we're going to go through Upstart, which had the worst quarter ever, but is up, I think, like 40+% in the aftermarket. It's kind of nuts. Let's go through the story. Past performance not indicative of future returns. As those of you that follow my Twitter know, I threw on some strangles right there at the end. Thank God, because my goodness, what a crazy move in the aftermarket. All right, let's just jump right into it. Okay, the biggest thing, I've got one definition for you because this came up, but I don't know what was weirder. The reaction of the stock, which in a lot of ways I kind of get, or the weirdness of the way that people ask questions on this call. I mean, I'll go through it, but I do want to, if you decide to do this call and just listen to it on your own, there is one definitional thing I kind of just want to go through because I've heard it thrown around. It's a little bit awkward. Fair value versus Cecil. Okay. Value versus Cecil still doesn't get you mark to market. I'm just going to share that with you now. Fair value is going to be expectations of credit losses. We haven't had any credit losses. So we know that that's not. So to try to be like, oh, did you do it with fair value or Cecil? Trying to pretend like we're actually asking the right question, which is how much you mark those things for, buddy, is just a little bit of nonsense. But definitely I encourage you to look that up because, I mean, yeah. Okay. The real reason I think why this thing is up is two things. One is a misunderstanding of like what this company's business model is. And that has to do with this misunderstanding of the 2 billion in funding that they got. So we're going to talk about what they actually do. What does Upstart actually do as an originator? Therefore, what is that funding, which they discussed over and over again, quite frankly. So what does Upstart actually do, and what does that funding then mean? Okay. And then the second thing is just that the short interest was over 36%. And usually the data on short interest can be up to 2 weeks delayed. So this is, to me, a classic short squeeze, because if there's new money coming in to this stock, then wow, you got cojones. Like, I mean, like this thing is really, really something special. All right. Okay. Let me just show you the thing that was misunderstood. Okay. And I see it reported. I even see it on Twitter like crazy. So it totally makes sense to me that this could be confusing. So they talked about 2 billion in funding sources, but this originator, okay, that funding source goes to potential loans that they then issue out. In this case, it was personal loans. But more specifically, the way that this business actually works, the way this business works is, they give you a rate, and then they may or may not actually then take the loan in the amount of time that you get approved and then go to do the loan. That's what got them over the last 2 quarters. And did anyone asking questions bother to ask if that was fixed? Nope. Why? Because I really think most of the people on the call, I'd never heard them before. So there may have been like one old analyst on the call. The rest, clearly every single time they would they would get their question answered a little bit, they wouldn't push because the answer that was being given was the weirdest answer. Okay, so that 2 billion in funding, it doesn't help Upstart, its balance sheet, or any of its business activities. It only does one thing, which is provide them more financing in the situation that they're able to get the machine started again. So the real question is, did they need 2 billion more in funding? And the answer to that question is no, they did not, because here's their income statement, right? They did. So this one, actually, you can see that revenue is down 67%. Now I'm going to show you later, since that's all fee-based revenue, I'll show you what that equates to loans, so you can see how amazingly aggressive the drop off in loans is. Unfortunately, they don't create a slide that just makes it super obvious, which became obvious to me that people didn't understand it when they were asking the questions that they asked on the call. So revenue down 67%. Okay, if you look, it's an L. It's a flat out L. Okay, on operating income of negative 131 million. And let's just be really clear what that L is. That means that they lost more than they made this quarter. That's a cash burn. Okay. So they're back to cash burn after only being cash flow positive for a very short period in history when rates were at 0 and they could do whatever. Okay. So it's not good. It's not good. Now, there's a couple of things in this that I can't be a complete jerk. I can only be a jerk because the thing's up 40%. If it was up like 5, 10, you'd hear a totally different thing. The thing is up 40%. It does not deserve 40%. That's all I'm saying. But you know what? Stranger things have happened because this is a cash burn. And right now it's really at risk. Okay. So now the things that you kind of want to talk about is this 45 million interest income, 52 million fair value adjustment. This is the least clear I have ever seen someone who got a really good situation happening present it. And here's what they specifically said and why I think that that's just a really bizarre way to show it. I'm not going to throw too much shade on them because Lord knows they're going to have a tough time these next 2 quarters once people actually figure out what was said on the call. But the $52 million mark is someone that is offered to buy loans. It has not closed and will not close until this quarter. So even though the quarter ended in March, we're in April, we're in May, the thing hasn't closed yet. And it's already in the financials for this quarter, which is a little bit, I mean, I'm just going to give it to them. I'll just assume that thing is going to close. But since they didn't really break out this interest income, it makes me think that their mark is 13%. And like I said, if you're using fair value versus CECL, you're still not actually taking an actual mark. So am I to think that your mark is 13%? That's what I actually have to mark your book down on. I don't know the answer to it because they didn't show it the way that I've asked every single quarter. I've criticized this. Every single quarter I've criticized this. And here we are yet again, me criticizing it. Okay. So there, that one, but again, this is a loan originator. Okay. So really, there are a couple of things that are positive in this. It's just the 40% that I'm reacting to in this kind of weird way, if you will. Now let's go through this adjusted EBITDA and what it was. Okay. The down 129 million, so painful, right? Is ugly. So then they tried to tell you what was comprised of that. And this you'll see is a stock-based compensation, certain payroll tax expenses. I was like, what is that? Because how did you get such a big number? I thought you just laid off a bunch of people. Okay. Apparently they settled something, and I think they said on the call 40 million, but since there's no replay and there's no transcripts, I can't confirm it. If you listen to it or you've subsequently confirmed it, stick it in the notes for everybody else. I don't mind being corrected or having people accentuate what's been said on my post. That's cool. But I think it was like 40 million, but let me show you how it looks. So that settlement is what it is. So that for whatever reason has to be adjusted for. I don't understand this. And then there's a bunch of other expenses, and that's what gets you to it, is that one thing. Now let me show you this other adjustment. That is why I'm saying I think it's all coming from that one thing. They have reorg expenses. I don't think this is their last round at the reorg table, if we're honest, but they seem to think it is. Fine, I'll give it to you. Do you know what I'm saying? But so that takes you from a loss of 158 to a loss of 47. In theory, that's better than the street expected. I don't know when they put out guidance. Maybe they did it at one of those analyst meetings, but I didn't see it in the last quarter. If y'all saw it in the last quarter, again, stick it in the comments. I'm happy to be corrected on that. But you can see the share count difference here, 84 down to 81, diluted 95 to 81. Now, the weirdness of that is last time I checked, if you compensated people with shares, that dilution should be incorporated in that number. So unless you're telling me all of this stock-based compensation was one thing, all right, cool, because you sure didn't buy back any stock. I'll tell you that much. You don't have the money for it. All right, so here we go here. $5 is the taxes paid related to net share settlement of equity awards. Other than that, and then proceeds from exercise of stock options. I'm not 100% sure where else to look for it, because when I looked on the cash flow statement, it wasn't clear to me exactly how to find this change here. So I'll just go ahead and admit maybe there's other people that are a whole lot better than me at reading these statements. Good for you. Thank you for sharing your knowledge if you can in the comments, but this was a little bit awkward. Okay, let's move on to the balance sheet, because the whole point here for me that has been my bugbear is that this is not a bank. And as it is not a bank, it gives you a fraction of what you'd need relative to a bank to assess whether or not this thing is really telling you a load of chocolate soft serve ice cream, or is actually being truthful with you. So things it doesn't give you are things like, what's your credit situation, right? Like what's the credit rating? Now that's despite the fact that they apparently do better FICO scores than anyone else. I just don't know what the FICO score is on what they intended to hold, or what they're now holding. Okay, so we're going to go through that. The other thing too is, if I've got it right, even though they kept referring to their book as short duration, if that is what I think it is on the income statement, we're talking about a 13% down mark, then you got about 3.5 years of duration. That ain't nothing, with all due respect. Watch my accent a little bit here. I'm having a little bit of White Claw, but this is my first one, guys, so don't think there's something else going on here. Okay. All right, let's go back to sharing slides. Here's your balance sheet. Okay, cash was down 82 million. I'm not That's not terrible, because total liabilities is down as well, 69 million. And then you've got this right here, which is loans at fair value, down 28 million. So they got 28 million worth of loans off the balance sheet. Cool. Okay, this is the mix of the loans that they got off the balance sheet. Now, this company primarily does do personal loans right this minute. Okay, they primarily do personal loans, and yet the mix of loans on balance sheet is primarily what? Auto. Okay, so and quite frankly, um, I know it really doesn't, Israel, but um, so it's mostly auto loans is what this book is at this point. I mean, you got a little bit more in core personal, but core personal, you're able to get someone to buy it. That's probably because your interest rate on core personals, it is what it is, and you don't have necessarily credit losses at this point. In autos, we don't necessarily have credit losses so much as you've definitely got asset impairment, because, like I've said in other episodes, if the price of the asset you repossess goes down by, I don't know, 13% according to CPI, then guess what you did? You wrote that business incorrectly as far as the loans go. That's why they can't get rid of the auto piece. So they're going to have to hold that to maturity. Now, the good news is that auto loans are typically 5 years. If it's done in some really aggressive way, it's 7 years. But honestly, if you're doing a 7-year loan, realize you're doing the entire depreciation, because most cars are fully depreciated 7 years. So that is really awkward as well. But that's the mix of loans that they still have. They got rid of a few core personal loans, but they still not only have all the autos left, but well, I'll say, and then some. Now, there's a couple more things I want to know. I want to show you. Um, it's a little bit frustrating to me, because trying to get a sense for what is the nature of these loans, which is the real question, right? They're saying that their ability to do credit loss math is better than everybody else's, even though everybody else has not had any kind of meaningful losses at this point. I think they show a slide of 55 basis points versus the average bank above 100 basis points. I don't know, because honestly, when I look through all the financial statements, people don't break out their autos exposure very much as far as their loss ratios go. Some of the bigger banks do, but the bigger banks got all kinds of extra stuff going on in there too, as relates to it's not apples to apples. So this is what I did. I just wanted to see, what is the average size of loan that this company is putting out. And the fact is, this quarter, it's much larger than last quarter. Somehow these personal loans have grown in average size significantly, even though they're doing a whole lot less of them. And so back to the question of, did they really need a $2 billion financing help vehicle, for lack of a better way? Because all that stuff is off balance sheet. Every single bit of that funding is off balance sheet, not on balance sheet. Okay. So did they need the extra 2 billion? The answer to that question is no, because they used to do $4.2 billion worth of loans. And now it looks like they did $1 billion worth of loans. Okay. That's how fast the loan pool is shrinking. So when we talk about credit tightness, y'all know that in more than one spot, people are like, it just happened all of a sudden. And every single time I say, no, that's not true. I follow Upstart, and I've been watching it for Upstart for 3 quarters, right? So this right here is what happened last year in March, when they had no loans on the balance sheet. I think they might have had like 200 million that they said they keep so they can do some testing. Now they got $1 billion, and it's more or less the same. But the average loan size is bigger. But what I find fascinating is, if you look at fourth quarter versus this quarter, you see that the personal loans are growing significantly, the average auto loan is down. Now, the only other thing you can take away from that is what does that imply as the type of person they're lending to? Because we still don't have an average FICO score like we would if you were a bank. Okay. So that I did a little due diligence here for you. This is just off of Car Guru's index. I got it off the internet. I wish I didn't put the link, but I'm sure if you guys look up Car Guru index, you should get the same thing. All right. Now I don't know the exact date or how often or how this data is collected, but that means that these cars that they're doing the loans on, unless they're asking for a whole lot down, are less than the average car. Now, it could be that they trend towards sedans, wagons, hatchbacks, and crossovers. I don't know, minivans, maybe. I don't think so, though. I think that that's a lower quality car is what's happening there. So that's what we've got. So I have said for many quarters, my real issue is that these marks are probably much larger. The actual marks, the mark to market mark, not the credit loss mark, is probably more significant than what they're saying. And then they had someone ask them that question. And the answer was, well, the 2021s probably have to be marked more than the 2020. And then no additional push to ask him to clarify that. I was like, this is the friendliest group of investors for a company that is down. They reported a down 63% revenue. Could you possibly have a nicer set of people on the call? Amazing. But, anyways, nonetheless, there you are. There's a last couple little things I just wanted to highlight. On from this. So yeah, the shares outstanding was a little bit awkward to me. This one right here was engineering and product development 49 to 110. Also a question that was asked in the sweetest possible way with a non-answer. I mean, if you want to learn how to give non-answers to questions by using jargon to act like you answered the question when you did not, then please listen to this call because that's what happened. All right. So here you see engineering product development up almost over 100%. And so someone asked the question, hey, so is this like just like you having to maintenance this with new data and it's upsetting? And the answer was like, no, we used to do it every 3 days, update the data, whatever, but more or less now we do it like once a month. This is all new objectives. And so then this was the only question that answered the question what that 2 billion in funding for, which is it's for an area of loans they don't currently do right now. That's what was missed by everybody, right? Because these are the slides. This is the slides that they have on the loans that they actually do: personal unsecured and auto secured. And the business that they're in theory going to do, that these loans are for personal unsecured, but then they talked about the fact that they would be growing into HELOC. Okay, what is HELOC? Some of y'all know because you guys are homeowners and you've had to take advantage of the HELOC rates. Other of you don't know, but HELOC is basically a loan where your house, a second mortgage on your house. Okay, so the 50 million that they're spending it on is to grow out of the existing businesses. Okay, so let me get to it. So that's what they're using it for, is so that they can expand into other forms of loans. So in summary, this is how you have to think of it. All right. If you want to be long the stock and you like it, you have to believe that whatever mess that they have in that 1 billion remaining, because that is still it, is going to be more than compensated for by new loans coming in. Rates are going to decline. Credit is still going to be wonderful. And they're going to grow that business, the HELOC business, given the margins that's getting versus what auto loans and personal loans used to get. They're going to grow that back to the $4 billion so they get the economy of scale. That's what your bet is, okay, at this point. And it's not a bad bet. It's just the timing of how long it takes, because meanwhile, they're going to be running cash flow negative to the tune of, well, you give them back let's say, since if they did the 54 billion or million deal, cool, awesome sauce, you give them back that, you're still running at an L. So it's however long it takes them to get those loans to pick up and definitely have the margins. And we'll see how it goes. Now, the other thing that was mentioned that does have some ramifications is people asked, who is it that gave you the 2 billion, right? They didn't say, but they did suggest that it was not a bank that did it. So it would be an asset manager. And then the last thing they'll say, because really, truly, the tone that you're getting where I'm a little bit more negative is only because this thing is up 40% in the aftermarket. In fairness, it could really go either way at this particular juncture in history, but they are in cash burn mode at this point. That cannot be denied. And they burned some of it, but they did get rid of some some of their liabilities as well. So it's not the worst cash burn I've ever seen. Nonetheless, it is a cash burn. Okay. But, um, the other thing is just that if the technology interface, the GUI itself, don't worry about the model because we all know the model is kind of irrelevant in a world where the issue isn't credit loss. The issue is mark to market on held to maturity. Okay. So your credit model, that's really sweet and everything. But what we really need is for you to have modeled so that you don't have $1 billion in loans that you're holding is held to maturity. And then the subsequent impact on credit spread widening as credit comes out and decides it just doesn't want to loan to anyone. Okay, that's what you really needed to model. We know that there's no way that that's what you modeled. I can just look at your macro model that you stuck up in there, and even if you're getting more of a spread, you're not compensating for just flat out no funding happening. So we are stoked. I am stoked that they got the 2 billion funding vehicle, and also I do think it's the GUI itself is worth something. I could care less about the model, like I said. And with that, that's all I've got prepared. Hopefully, that covered it for some questions. I'm not seeing a lot of questions in here. Shout out to Israel. He has one little baby question. Um, what do they do and what oh I'm so sorry Israel, they are a loan originator. So this is what they're supposed to do. Okay, they're supposed to be the person that you go to. There's okay, so it used to be the case that you'd have to go and get approval. You fill out a million documents, and then 1 or 2 days later, they'd come back and be like, "You are approved for your loan." And the portion, probably this becomes the most apparent when you're doing your home loan, which could take forever. Okay, so that's in theory what they're going to do is they're going to somehow shorten the time on that, and that's what the 50 million is. Okay, the other thing would be if you go to get your auto loan taken care of, and they go in that back room, and then suddenly you come out with a loan. That's what they're doing that facilitation. In theory, that's what they're doing. In practice, they ate $1 billion worth of the loans over the last 4 quarters. So that's why when you see some of my other videos, I become a little frustrated because the loan originators eating loans is what actually was the first sign of distress during the 2008 crisis. Y'all go back, you can see it because a loan originator is not designed to be carrying $1 billion worth of loans. That turns you into an asset manager at that point. You got to get them off. Yes. So that's what they're supposed to do is be a loan originator. Now, you realize that even though there are some things that are going that are very positive, if you have $1 billion worth of loans and you have not as much in revenue as you used to have, 1/4 of what you used to have in revenue, something like that, 1/3, however you want to, depends how you measure it, net versus gross, whatever. Okay, then you have become even more of an asset manager of loans. So there is that as well, which still makes it problematic, which is why up 40% has me a little bit making fun of it more than really admiring the progress that was made on the quarter. So that's what's going on, and hopefully that was the correct, helpful answer for you. A good question. And then this question I will answer: what type of White Claw am I enjoying? Um, Ruby grapefruit. That's what I decided to have. So I don't know if you have a favorite White Claw flavors. Feel free to stick it in stick it in the comments. Um, I don't know if the stock market makes sense anymore, but I will say for sure that short interest was very high. So I can completely appreciate why that thing might be up 40% on a short squeeze. That if somebody was like, May, this is a short squeeze, I'd be like, yes, it is. But if somebody's like, May, this was a fabulous quarter, they're clearly going to be crushing it and are worth their valuation given what we've read, given specifically what was on this quarter. That one I'd have a tougher time with. And let's see what else we got. That is about it then. Thank you guys. Jake, thanks for stopping by. Novocaine, thanks for stopping by. And good luck tomorrow. This market is nuts. And good luck on your investments. Bye, guys.